right, I'm going to start with just introducing myself. Jill Cetina. I'm a professor of finance at Texas A&M, also associate director of a commercial banking program that we run both for undergraduates and graduate students there, and am affiliated as well with BTRM, proudly affiliated as the North America director, and also I'm a member of faculty, been teaching this week. So Małgorzata, why don't you introduce yourself as well?
Oh, thank you, Jill. Małgorzata Tynecka. I'm one of the BTRM faculty. I have now close to 20 years across different areas of banking, risk management, and treasury, mostly in banks, but I've been in advisory the past 3 years. So that allows me to see maybe different perspectives from a range of banks of different sizes as well.
Okay, all right. So we're going to jump right in. I'm going to try sharing my screen. Hopefully this will work better than some of the other things. Let me just see. Okay, are people able to see that all right?
I can see the screen.
Perfect. Okay, so I'm going to just start off before we jump in to the webinar, Małgorzata and I, with a few opener remarks. And, you know, I didn't talk a lot about my background, but someone who's basically been a lifetime mentor to me, both owned a bank, he's now retired, both owned a bank and ran a hedge fund. And, you know, I think one of the things when I think about banking that I from him and continue to think about is just what's happening with the overall macroeconomy is, as we all know, very important for banking. And, you know, the title of this webinar that, you know, Małgorzata and I are doing with you all today is about, are we in a new era, and a view from the US and from Europe. And from the US perspective, I'm going to argue that we are in something of a new macroeconomic era. It has been, I will say, flirted with in terms of prior US administrations, the idea of there being a need to kind of, or a desire to rebalance, I'll use the word desire as opposed to need, a desire to rebalance global trade because there's been significant growth in US imports. And I think, you know, even if you go all the way back to the Obama administration, there was attempts on the part of the Obama administration to change some of the dynamics around international trade and have the US export more, import less. Really, it has come to this administration for that to, those desires, again, I'm not going to use the word need, to actually have some impact. And as we all know, we all saw in April, and I did a webinar on the tariffs for BTRM, but the tariffs that this administration has put in place are having a significant impact. And I think we are in the process of effectively convincing other countries to change their currency policies and to export less to the United States. Why is this important? Why is it important to banking? Because I think it has profound implications and gets back to the title of this talk, which is kind of a new era for banking. As we all know, many of us for the last 15 years have been in an era of banking characterized by, interest rates being very low, significant expansion of central bank balance sheets, and it feels like we have pivoted in a very significant way in terms of the macroeconomy. And this is meaningful in terms of thinking about bank risk management if we're in a completely new macro regime, because it is meaningful in terms of our risk models and overall, the way in which we try to run a bank if we're in a very different and new macro regime. So maybe I'll just, before I jump into the slides and speaking more about the banking outlook, just a couple of words on my outlook for the US. It is a time, I think, where we've gotten past Liberation Day with the tariffs. and now are trying to think about what does it mean for the economy. We've seen the data come in softer. It is still my view that we are likely to see stagflation, but probably not get into a recession. Why? Because basically we have very significant fiscal stimulus that will, we're going to be running a budget deficit of at least 7% of GDP. And with that budget deficit widening into 2026 under current tax proposals that are before Congress. And so I think more likely where we end up is the unfortunate place that I think I've talked about in some other events for BTRM, which is we end up with a stagflationary environment that puts the Fed in a bit of a pickle with regards to growth being subpar, but at the same time, inflation being still above the Fed's target. We were on the path for inflation to come back to target, and that path has been disrupted both by the tariffs, which I think we're going to see those inflation impacts show up in a couple of months' time. And then we'll see what unfolding events in the Middle East, which are having implications for oil prices and other flows of goods and services through the Straits of Hormuz mean for inflation. But that is my baseline expectation of soft U.S. economic growth, as well as inflation staying above target. I think that some of the Fed rate cuts that are even priced in into year end are a bit optimistic. So with that, let me kind of turn to our slide deck. And I'm going to open with talking a bit about US and European bank metrics, because I think there's some interesting things to kind of highlight there. Talk a little bit about US perspective, and then kick it over to Małgorzata, her thoughts on what it looks like in terms of European bank risk management and what is maybe new and different there. And then we'd like to open it up to you all. And thank you again for your patience with us kind of launching the webinar and a little bit of the challenge at the beginning, but would very much like to take your questions. So with that, what to highlight here? Well, basically, we started shortly after the US election, and I remember it distinctly with my students in the business school, with very high expectations for what was going to happen in terms of share price performance for US banks. And banks were part of the so-called Trump trade after the US election. And you can see here I've graphed the KBW US Bank Index in red, and then the iShares stocks Europe 600 Bank Index in blue. And the key takeaway here is that, just to put a point on it, European bank equities are, really outperforming U.S. banks. And, this is, I think, something that, even sitting here in Texas, I have people reach out to me and to want to talk about, the outlook for U.S. banks, and European banks come up as an alternative that global investors in both bank bond and bank equity are thinking about. You can kind of see that really captured in this chart. I think there's a couple ways to look at it. There's a European positive way to look at that, which is to say that, as defense spending ramps up in Europe, that and some of the approaches that European banks may have with regards to defense sector spending may change, that there's great opportunity in terms of lending in Europe on the part of European banks, as well as a sense that there may be some disinflationary impacts from the changes in terms of global trade that reduce interest rate volatility in Europe and make for a better banking environment. On the US side, I think some of the ways in which some of the conversations that I've had and things that people, in these exchanges that we've discussed about US banks is the fact that there is a greater potential for interest rate volatility. We know from what happened with Silicon Valley Bank and some of the other banks in the spring of 2023 but interest rate risk in the banking book remains a challenge for the U.S. banking sector. So not, to use my old Moody's speak, not credit positive necessarily, that we have a lot of expectation of rate volatility for the U.S. And then concerns about, rising recession probability and certainly stagflation and what that would mean for U.S. banks. Of course, stagflation is one of the most challenging macroeconomic environments. And I think that kind of underpins the why of this chart. So a bit of a glass half full for European banks and a glass half empty for U.S. banks in terms of macro outlook. You guys will get the slides, after this webinar, but basically this is the DRAM function in Bloomberg, and this is basically the former Lehman Brothers credit trading model, which Bloomberg acquired out of the Lehman bankruptcy. And this is a Merton model that attempts to estimate, given the moves in equity price and equity price volatility for any publicly traded bank, what's the estimated default probability? And I did two screenshots here. The upper screenshot is for Western European banks, and the bottom screenshot is for US banks. I did this a couple days ago. But what's the core point here? The core point, and you can look at this at your leisure after the webinar, is that basically implied default probabilities, I have these sorted from highest default probability to lower default probability. I'm not showing all of the banks, obviously in Western Europe and the US that have publicly listed equity. But basically the takeaway is that the tail in terms of higher estimated default probability, those higher default probabilities sit with US banks in terms of what these credit models would show, not with European banks. And that's very interesting to sort of see. So, and relevant potentially for fixed income investors in banks globally. So now I'm going to turn to just talking briefly about, the US bank risk management and kind of why we're in a new era. And so, why US banks may no longer be perceived by some investors globally in banks as the top dog. Well, first, if you're a student of banking and know some US banking history, there is some dimension in which some of the dialogue today around deregulation and desupervision is a bit of a 1980s flashback. So, President Reagan, during his administration, pursued a policy path like this. And this, coupled with elevated inflation and problems in terms of managing interest rates, was the source of the savings and loan crisis in the United States, which cost the US taxpayer about 3% of GDP. Some of the lessons from the savings and loan crisis included that unfunded resolution funds can be challenging for the banking sector, can create concerns around the banking sector. And unfortunately, in the US, while we do have the DIF, or the Deposit Insurance Fund of the FDIC, what happened in 2023 has significantly drained the FDIC's Deposit Insurance Fund, so that if we had further banking sector problems in the United States, that would come in the form of assessments on healthy banks. The other thing that was a big lesson in the 1980s was the need to close insolvent institutions promptly. And it was President Bush who, following his election after President Reagan, came forward with the FDIC Improvement Act and the whole idea that we needed to have more focus on prompt corrective action. This was part of the legislation that he brought to bear, recognizing that unhealthy banks ultimately have negative consequences for healthy institutions and pollute the banking environment. So I do think that there's some, I'll say, questions or concerns about that topic as well. Particularly, we have still over 400 billion in unrealized securities losses in the banking sector. We have the potential for a slowing economy. We have the potential for further upward movement in the 10-year Treasury yield once Treasury gets its debt limit increase, as is expected in July, and that will weigh on commercial real estate, and that some of these problems that were not really dealt with effectively in terms of embedded interest rate risk dating all the way back may now buckle a bit at some institutions as the economy experiences some deceleration. I alluded to in my opening remarks some concerns about that, what we're doing in terms of tariffs and changes in foreign exchange policy. And needless to say, the recycling of, by foreign countries of their exports to the U.S. into investments in the U.S. has been something that has been a feature of the global economy really for the last 50 years since the end of World War II. And so to the extent that that system is changing, I think that there definitely poses risks to tighter financial conditions as countries choose to move their exports away from the U.S. and as a result hold fewer dollars, while at the same time we have the same level of kind of investment needs or even higher investment needs because we are now trying to produce more goods in the U.S. economy ourselves. So I do think that there's a risk in terms of a breakdown of, in terms of historical relationships that banks may be using, to help risk manage major parts of their business. Turning to my third bullet, sovereign bank nexus and how this creates risks. Basically, what am I getting at here? The idea that risks from, banks can transmit to the government. The IMF, if you've not seen it, has a very nice post that they just did in the last few weeks on how SVB's failure actually caused an upward move in U.S. sovereign CDS. You should check it out. I've given you the headline, but that was sort of the takeaway. But you can also flip it around where sovereign stress and pressure on long-dated Treasury yields creates an impetus to try to mobilize the banking sector through changes in bank capital regulation, basically hold Treasuries without having to have perhaps capital from the leverage ratio behind that. And so, these kinds of interactions can create very significant risks that, again, we've not seen in decades of banking in the U.S. and really aren't in the data. Case in point, we basically are starting to have, I think, a political conversation in the U.S. about de facto taxing the U.S. banking sector in a unique way. What am I alluding to? The discussion that seems to be starting on the Hill with regards to potentially not paying banks interest on their balances at the Fed, okay? And so just as tariffs are a tax, but, described using different words, so too is not paying interest on reserve balances that banks hold at the Fed. It's a de facto tax. There are European countries that instead of doing this have just outright taxed the banking sector to try to recoup some of the interest that they were paying to banks for these reserve balances. But I think this sort of speaks to how some of the sovereign challenges, banks are not immune from that. And the very levered position of the US government has implications for banks. The 10-year Treasury term premium looks to have structurally pivoted to me and to be rising. And I think this has profound implications for commercial real estate. Many of the banks and indeed broader investor community in commercial real estate, pretty much their whole working lives, the 10-year Treasury term premium has been coming down, and that's been supportive for commercial real estate. I think we've now moved into a different environment, and we'll see what that means. Growth in private credit. Growth in private credit, I think, relates to two big macro factors. One is, of course, the fact that we have the leverage lending guidance in the US, which significantly disincented banks from doing this type of lending and really opened it up for non-banks, coupled with the fact that life insurance companies need higher yielding assets given basically greater longevity risk and the need to go off and find those assets. So I think we have seen banks be less involved in credit intermediation as a result. And instead, my view is that what we have in the banking sector is more provision, I will say, of contingent liquidity to these non-bank types of entities. And that poses its own risk, particularly if poorly priced. So we can come back to that if there's greater interest. In terms of US prudential standards, as I already alluded to, some of the sovereign bank nexus, I think means that, and also the deregulation and desupervision environment is creating a bit of a situation where everyone will remember after 2008, the US not only implemented the Basel standards, but it actually adopted higher standards than what was coming out of Basel. And this was referred to in the US as kind of gold plating Basel standards so that we would never have an event like 2008 happen again. It appears to me that we are likely, particularly for the very largest US banks, to move away from that. There's discussions about particularly the enhanced supplementary leverage ratio that affects the US GSIBs, potentially changing that flat 2% that's added on top of the 3 for SLR and moving to, like, as was previously proposed back in 2018, 50% of the GSIB surcharge. I think there will also be an effort to try to eliminate. In the US, we have two methods for calculating the GSIB surcharge: the Basel method, which is referred to as method 1, but what is always the binding constraint, or what is implemented in the US, is method 2. And I think method 2 very significantly increases GSIB surcharge for a range of US GSIBs, in some cases as much as 200 basis points or more. And this is important because if we change both the enhanced supplementary leverage ratio and change the GSIB surcharge calculation, there will be significant capital that is unlocked at US banks, particularly our GSIBs. And then the question becomes, A, what they do with that capital. Do they return it to shareholders or do they lend it? And if they lend it, then they will be in a very competitive position relative to smaller US banks that are not subject to those same standards and will not experience any easing in terms of their capital standards. And then, of course, we have in the US CCAR, which is an important stress test, supervisory stress test, but which is facing some legal challenges from the banking lobby. And we will see under the current administration what kinds of changes are made to CCAR. I don't want to say too much or be too negative about that. I think some changes could be very valuable, but if the stress test is meaningfully weakened at a time when the economy is decelerating, bank credit investors may not take that well. And so I think this is important. So, this is all sounding kind of a bit gloomy, and I apologize for that. But what can banks do in light of this environment? Well, I do think that one of the things that is particularly evident when we get into some of the smaller US banks is the need to discuss passing the torch. As I think many who may be on the call from the United States know, there's certainly a lot of people who are, in their 60s, 70s, and sometimes even older than that, who are involved in bank management or on bank boards. And it may be time to really look at some generational shifts and passing the torch as opposed to just selling the bank. I do think that there is some potential for, as things get more challenging from a macro viewpoint and in terms of also a banking viewpoint, for some institutions, given the generation, just to decide to sell the bank or sell assets out of the bank. So I do think that will be interesting. Up your game. I do think that trying to upskill in this environment, it is a environment where, this is where part of why I partner with BTRM, because it is my sincerely held belief that we are going through a structural change where bank balance sheet management may have been, it's always important, but it becomes even more important in this type of an environment, and being very thoughtful and deliberate. So upskilling your team in this environment and upgrading data and models, and thinking very carefully about, is it best to use data from, say the last 5 years, or should we try to understand some historical relationships as well from prior stagflationary periods? That may not be data that your bank has, but still look at some of those macroeconomic relationships and think about, how that might manifest at your institution. I've said this point already, so I won't repeat it, but I do think that the TV channel has changed. And I think a lot of people still think we're on the old channel, so I won't beat on that point too much. Giving away liquidity and optionality. Again, there's some metrics that I look at that suggest to me that expectations are that rate volatility in the US will be meaningfully higher than other advanced economies. And this is important because if you're giving away optionality on either the asset or the liability side, then if that higher volatility is realized, you may find you've not priced the product quite correctly. Liquidity, I do think one of the things that's so striking about what happened in terms of Liberation Day and the period of extreme volatility in April was that we did not have meaningful challenges in terms of money markets in the United States and overall funding, which was great. But I don't know that I think that's the future. I think debt limit and the fact that Treasury was not as involved in issuance at that time may have played a role in helping. And so I think this is very important. And then regulatory compliance. I do think that there are some institutions in the US that view regulatory compliance as kind of the bar that they're aiming for. And if that bar is falling and macroeconomic risks are rising, at the risk of being very painfully obvious about it, that's not the bar that where you want to set your risk management. So this is important as well. And I would just emphasize, I think we are in a new world and people need to plan for volatility and think about their buffers. So with that, Małgorzata, I'm going to kick it over to you to talk about how it looks from your perspective in terms of European banks.
Mm-hmm. Okay, so I have selected a subsection of topics. It was largely driven by what is topical, what do I find, repeated over conversations, both formal and informal, across a number of European banks. Is this everything that's, on top agenda? Not necessarily, but obviously we have to limit ourselves to some degree. There are also some items that I have not included, like the elephant in the room. Well, that was well covered by Jill around the tariffs and volatility resulting from that. Maybe if I can just add on to what Jill said. What's been happening the past few months is definitely unprecedented realization of political risk from the economy, where we wouldn't have, as risk professionals, typically expected it to come from. and cause that degree of volatility. Obviously, it flows through into the decision making, which also Jill touched on. Are the numbers that we look at, the historical levels over the past 5-10 years relevant in the current world, or shall we go back more in the past and look at some of the scenarios and how they panned out in the previous historical periods? That's definitely a valid question. On the points on my agenda that I wanted to touch on is obviously the rapid policy hikes by the ECB and Bank of England that boosted banks' NII across 2023, but these margins are now tightening. So earnings at most of the banks are likely to moderate through the rest of 2025, and central rate cuts will generally lead to lower NII, and particularly for Southern European banks. I do believe that some French banks and some UK banks will fare better. I would also expect a slight rise in loan impairment charges and credit demand that will be muted as a result of that general volatility and lower decision-making willingness across parties as the tariff uncertainty rolls out over here as well. I think one of the items here, what can be also happening in anticipation of that, I think some of the boards of the European banks are aware of the margins tightening, and they're looking at what can be done to potentially lower the cost base through a number of obviously decisions that are more market focus, like repricing the deposits or some hedging decisions that are being made. But I think an interesting angle is also quite a lot of organizational change that is probably coming up across European banks to target this new environment that might be more financially challenging because there is like less of a buffer to operate within successfully and generate those returns to the shareholders. The second item is more of a regulatory impact item where I touched on Basel III Endgame capital rules. So these are the final Basel III reforms, CRR, CRD6 in the EU, and analogous rules in the UK, taken effect from January this year, which include the output floor that limits how much internal models can reduce RWAs. And generally speaking, industry studies have shown moderate capital impact on average. However, that impact might be higher for tier 1 banks, GSIBs in particular, compared to group 2 banks. This is largely probably explained by the fact that larger banks more often employ the IRB approach, and their results are more heavily impacted by an increase in the IRB floor relative to smaller counterparts. That expected impact will vary across the institutions, and it is something to account for, and a bit more of a slow burner that might materialize over the next 3 years gradually. The third item is obviously the banks are now losing the support that there's been from the central bank funding in the pandemic era. And in particular, banks in Italy, or I included here banks in Italy and Germany that are heavy users of this type of funding, might need to boost market funding to replace ECB loans and be more of active bond users. This is one of the trends that I also wanted to cover. And the last one, apologies for that, I had a bit of a glitch. The last one is around operational resilience rules, which is also some regulatory requirement that I have selected for a reason that there was a particular regulatory scrutiny around it. So firms can suffer a substantial impact in terms of penalties if they don't comply. Also, in terms of the operational resilience as such, and cyber security. In particular, in the UK, it wasn't a banking institution, but the case of Marks and Spencer that has been heavily impacted in terms of their operations by the recent attack has resulted in a number of banks in the UK and EU reviewing the policies they have in place, the cybersecurity aspects, but also linking it with the liquidity impact of what that security breach event could mean to them. So it's quite a scenario that's being actively tested across a number of the institutions. In terms of the DORA compliance itself, it has been quite a rushed, I would say, process for a number of banks. And I think around 40 something, it was 60 of banks that were compliant versus non-compliant with the regulation when it was due. I think it has been one of those instances where a regulation came through with a 2-year notice, but quite up to the last minute, a lot of financial institutions did not understand the true impact it may have on, and the true meaning of some of the requirements. So even though it's been past due, I believe there will be a lot of focus on that area that needs to continue in the following years. I think in terms of doing things differently, that the institutions, I mentioned the Southern banks, Southern and South European banks. In particular, when I mention them, I think about, I don't want to throw anyone under the bus, but thinking about, for example, Portugal, where you've got roughly 90% of mortgages that are fixed to Euribor. Obviously, that sensitivity, the interest rate moves, is much more significant. At the same time, there might be a pressure to keep those the deposit rate higher, due to a number of factors that are specific to market and economy, as well as peer pressure, and making it attractive for the customers. Also, those banks have lower hedging options, so they have less access to interest rate derivatives, and they also have limited access to some of the strategic hedging solutions, which could impact how fast they're able to act and reprice when it comes to it. The second point is more related to the funding cliff, and address the sovereign bond duration and bond and liquid asset mix, in terms of that strategic or tactical thinking about your balance sheet management and what the banks should do. And the last point does ring to what Jill has mentioned. So operational resilience should be treated as a principal risk. It should be tested in conjunction with other market and liquidity risks in the bank. And my recommendation would be not to get lost in compliance. So don't take it as a tick box exercise. Just focus what you're trying to achieve and move that agenda forward in terms of making your bank a better institution and from operational perspective as well.
Great. So I think that we are at a place where we are happy to take questions. And let's see the chat here. So Małgorzata and I would welcome questions from the audience or even challenge, but I think, we see some commonalities. I think it's fair to say about, I didn't talk about operational resilience. I used to be a bank supervisor and I had this in my area, and I agree with what you just said, Małgorzata, like kind of over focusing on compliance as opposed to recognizing that, needless to say, cyber and operational risk is a real risk is very, very.
So if I may, because there are no volunteers from the group, you did mention private credit as within banks. Obviously, this is not a new asset class as such, but I think it was more popular with other financial institutions such as asset managers or pension funds in different sorts of investment managers. But right now, I think banking industry is more open to that asset class. And maybe if you could elaborate more, what's your view on this type of asset class within banking portfolio?
Yeah, no, it's a great question. I think a couple of things. I think first, we've had a situation where banks were restrained from being able to lend to some of these borrowers through the leverage lending guidance that came out in the United States. And so I think this opened up that opportunity. And then you also had on the, as I said, on the insurance side, and even I think we're seeing it in some fashion with U.S. university endowments and pension funds, that people were looking in this world that existed pre-COVID for higher yielding assets, and so private credit kind of stepped into that. I do think it's an interesting question. A couple of things: whether people have price the liquidity in the banking sector that they're giving to private credit appropriately. In all cases, for very largest institutions, I would hope that's the case, but there are some smaller institutions, smaller banks in the US that are starting to get involved as well with private credit. And I guess that's where I wonder. And then I think the other thing that's really interesting is that part of the premise of private credit is, and when I've talked to some people involved in private credit, they've made the point, well, we don't use deposits, we match fund the loans. We go off and we do a borrow and we match fund. Very true. But I think one of the interesting points is that if the economy slows and the borrower gets into distress, how are they going to be able to roll potentially if they need to work with the borrower, engage in a workout, whether that is really plausible for them and whether that becomes a moment in which they try to draw on bank liquidity. So those are just some high level thoughts that I have on that topic. I see we've gotten a few questions in the chat. First one looks like it's for you. Fundamental Review of the Trading Book is running at a faster pace in the EU than in the US. Would this create a competitive advantage to European banks? I don't know if you have a thought on that.
So not specifically on the fundamental review of the trading book as such, but it is quite a common challenge in terms of managing organizations where you would have an American bank with a subsidiary in Europe. You do see quite a lot of the banks operating at different speeds in terms of implementing solutions or aligning to the regulation, which can cause maybe not competitive advantage, but even within the same wider company, within the same holding group, a mismatch of how certain things are accounted for or the financial impact of certain decisions. So on the authority B itself, I cannot say for sure. I don't want to make any strong opinions on this particular one, but I think it does link with an overall trend where if you see a certain degree of deregulation in the US that's being supported by the top policymakers in the near future, you would question what would be the response of European and for example, Bank of England. I think there is maybe not loudly said anyway, but there is an opinion that there is a certain level of regulation, regulatory rules within the EU and in particular UK regulation I would see as super equivalent to EU as well as the US. Meaning that it could potentially result in a drag in terms of resourcing needs and amount of capital or liquidity that you need to hold. And in the environment where banks are starting to look very carefully at their organizational setup as well, that cost base might be rethinked as well if being present in a specific economy within a specific geography where those regulatory rules are more stringent and resulting in maybe higher cost of running the business if it's still financially viable over a longer term.
Interesting. Maybe there's a couple more questions. So maybe I'll just one from a tool. Any impact of U.S. banks getting hit on the world economy? So maybe I'll just kind of couple thoughts on that. As I said in my beginning outlook, I think we have the likelihood in a couple months' time for us to see inflation move up. In the U.S., like I was looking at the break even at the front end of the Treasury inflation adjusted securities earlier today. It's got CPI priced as realizing, a little bit below 3.5. And then I think, the thing for me that I take a step back and say, we had the experience of negative supply shocks, followed by fiscal stimulus in the US, creating inflation. And to me, it feels like we're doing it all over again, where this time the negative supply shock isn't COVID, it's tariffs. And then we're going to basically do fiscal stimulus. And, it may not be as massive, but still end up with higher inflation. Why is this relevant? Because what borrowers need from banks when inflation is higher is they need larger loans, right? And so this gets back to the discussion of capital. If banking sector capital is coming down as inflation is moving up, the banking sector's ability in the US to intermediate as much in real terms is less. And so this is not good for overall US economic growth. I think the fact as well, or the concern as well, it's not a fact at this point, but I think it's a concern that I have, that there may be kind of a pullback from some bank investors in terms of the US banking sector, and a greater focus on looking at opportunities in terms of large global banks and other economies. I think that reduces US banks' ability to intermediate for smaller types of businesses in the US. So I think from that vantage point and tool, that would be kind of how I would see it having an impact in terms of slower US growth, and overall, of course, slower US growth, given its size, is negative for global GDP growth. So that would be kind of how I would relate that. We've got 2 more questions. What would be the real impact in terms of NAI and EVE on US banks of President Trump's financial services deregulation? Unfortunately, we don't have IRBB. We never adopted the IRBB standard in the United States. So, and we made no reforms in the United States after Silicon Valley Bank's failure. So, I think it really comes down to supervision and regulation, and people say with some regularity that they don't want banks to fail, understandable, because that can be costly and destabilizing. But it's not very obvious that we've done much in terms of supervision or regulation. I do see some banks making progress on these topics, independent of supervision and regulation, recognizing the need. But then, other banks less so. Without talking too much out of school, was speaking with a bank here in the US that they said, well, I have C&I loans on my balance sheet, which are all floating rate. So I don't need to be thinking about interest rate hedging. And I said, are you offering your borrowers interest rate hedges? And like, no. I was like, well, you have interest rate risk exposure. So I still think there's a lot of growth or change that kind of needs to happen on these topics, but I don't expect any kind of improvement in terms of where we are on NAI and EVE. And the prior administration did nothing after SVB to make a regulatory or a meaningful supervisory change that I can tell. Yes, more exams, but what's the content and what's the impact? We've got a couple more questions. This is from Yasvinder. Big US banks argue that Basel III Endgame would restrict lending and hurt global competitiveness under the US administration with the regulatory leanings. Do you expect some changes in the US approach on capital regulation implementations compared to the Basel proposed rule? PRA in the UK has already delayed the implementation to January 1st, 2027. I'm very skeptical that Basel Endgame is adopted in the US, and I think more to the point, we're looking.
I do agree.
Yeah, it's not happening. And I think more to the point, what we're talking about is some things that were adopted after the GFC, say in like the 2012, 2013 era, in terms of large US bank capital, that gets, for lack of a better word, unwound. So I don't think we're going towards Basel Endgame. I think we're instead rewinding the tape. And again, I want to just really emphasize this. It looks to me like right now, a lot of that trajectory is focused just on capital relief for US GSIBs, which will, in my view, have competitiveness effects if implemented in that way for community banks and regional banks in the United States, as well as globally. So I hope that helps. And then Michael posted something from Wendy on LinkedIn. Thanks for that question, Wendy. Does it seem as though the banking industry may have become too comfortable with leveraging insurance, cash failure, and or death benefit of a guarantor as a mitigating factor in credit lending decisions among mid-market investment banking silos, rather than apply full due diligence in the analysis for a going concern borrower to meet the forecast in a pro forma? I don't really have a strong view on this. This is not a topic I'm close to, Wendy. I don't know, Małgorzata, if you have any thoughts on this issue.
No, sorry. I think I cannot add on that credit risk assessment question. I think it's basically coming down to that.
Yeah. So, all right. Well, we, on behalf of Małgorzata and I, we had fun prepping this together and, talking a little bit about what was different, what was the same in terms of a new era for the US and Europe banking. And we hope it's been helpful to those of you who are able to join.
Thank you very much, everyone.